If you don't control your business money in the next 30 days, your business will control you. Most owners think they have a revenue problem, but the real issue is lack of budgeting. In this video, you will learn how to start business budgeting in 30 days. Let's start with the first 15 days, because budgeting is not about guessing numbers, it is about collecting the right data. During week 1, your only job is visibility. Open your business bank statements from the last 3 months. If you use accounting software, export your profit and loss statement. If you do not, simply download your bank transactions into a spreadsheet. Now divide every expense into clear categories. Keep it simple: revenue, cost of goods sold, payroll, fixed expenses, variable expenses, debt payments, owner pay, and taxes. Do not overcomplicate this with 40 line items. The goal is clarity, not perfection. Once categorized, calculate your average monthly revenue for the last 3 months. Then calculate your average monthly total expenses. The difference between the two is your baseline cash flow. If revenue is $40,000 and total expenses are $35,000, your average monthly surplus is $5,000. If expenses are higher than revenue, you now clearly see the gap. This alone is powerful because most owners operate emotionally, not numerically. Week 2 is about identifying fixed versus variable expenses. Fixed expenses are costs that do not change much month to month, such as rent, insurance, subscriptions, and loan payments. Variable expenses fluctuate, such as marketing, shipping, utilities, freelance help, or inventory purchases. Highlight every fixed cost in one color and variable costs in another. Now ask yourself 3 critical questions. Which expenses generate revenue directly? Which expenses support operations but do not generate revenue? Which expenses add little value? This is where many owners discover silent leaks like unused software, overpriced vendors, or marketing channels that do not convert. Even cutting 5% of unnecessary spending can significantly improve margins. During week 3, you build your first working budget. Start with projected revenue. Do not use your best month ever. Use your realistic monthly average or a slightly conservative estimate. If your average revenue is $40,000, you might budget $38,000 to stay cautious. Next, list your fixed expenses exactly as they are. These are non-negotiable in the short term. Then assign controlled limits to variable expenses. For example, if you spent $6,000 on marketing last month without tracking return, you may set a budget cap of $4,500 while measuring performance more closely. This step forces discipline. Now include 3 critical lines most small businesses ignore: owner pay, tax reserve, and emergency fund. Owner pay should be treated like payroll, not leftover money. Taxes should be estimated and set aside monthly, often 20 to 30% of net profit depending on your structure and country. The emergency fund should receive a fixed percentage allocation, even if small at first, such as 3 to 5% of revenue. This protects you from slow months, equipment breakdowns, or unexpected costs. Calculate your projected net profit under this new budget. If revenue is $38,000 and total planned expenses are $34,000, you now have a controlled $4,000 projected profit instead of random results. This is the foundation of financial discipline. By the end of day 21, you are no longer reacting to money, you are planning it. The numbers may not be perfect, but you now have structure, clarity, and control, which is far more powerful than guesswork. Now let's focus on days 22 through 30, where you shift from creating a budget to actually living by it. A budget only works if it becomes a weekly habit, not a document you build once and forget. Start by scheduling a 30-minute money meeting with yourself every week. Put it on your calendar just like you would a client call. During this meeting, compare 3 numbers: projected revenue, actual revenue, and total expenses for that week. Do not wait until the end of the month. Weekly tracking prevents small problems from turning into major cash crises. If your weekly revenue target was $10,000, but you only brought in $7,000, you immediately know there is a $3,000 gap that must be addressed. That gap may require increasing sales activity, adjusting marketing, or delaying discretionary spending. This is how budgeting becomes proactive instead of reactive. Next, focus on cash flow timing, which is where many businesses struggle even when they are profitable on paper. Profit does not mean cash in the bank. Look at when money actually enters your account and when it leaves. If customers pay you in 30 or 60 days, but you must pay vendors in 15 days, you have a timing mismatch. During this final stage of the 30-day system, create a simple cash flow calendar. List expected incoming payments by date. Then list fixed outgoing payments like rent, payroll, software subscriptions, loan payments, and taxes. This visual view immediately shows tight weeks in advance. If you see that week 3 of next month will be short on cash, you can prepare early by collecting receivables faster, negotiating vendor terms, or temporarily reducing variable expenses. This single habit separates stable businesses from stressed ones. Now let's talk about adjusting your budget intelligently. Your first month will not be perfect. That is normal. The goal is progress, not perfection. If your marketing budget was set at $4,500, but you discover that one channel is generating strong returns, you can reallocate within the category rather than blindly cutting spending. Budgeting is not about restricting growth, it is about directing money toward what works. At the same time, if certain expenses repeatedly exceed their limits without generating measurable results, that is a signal to either renegotiate, replace, or eliminate them. Every dollar in your business should have a job. Another critical step during this final week is building discipline around owner compensation. Many business owners either overpay themselves during strong months or underpay themselves during slow months. Both create instability. Decide on a reasonable, consistent owner salary based on your budgeted profit, not emotional highs and lows. If extra profit appears at the end of the month, allocate it intentionally, a portion to reserves, a portion to reinvestment, and possibly a portion as a bonus. This prevents lifestyle inflation from damaging business stability. Finally, measure your progress at the end of day 30. Ask yourself 4 questions. Do I know my exact monthly revenue target? Do I know my fixed and variable cost limits? Do I set aside money for taxes and emergencies consistently? Do I review my numbers weekly? If you can confidently answer yes, you have successfully started business budgeting,